Hey traders, you're welcome back to the Forex Geek channel. In this video, we are going to be breaking down a powerful yet underrated indicator that can completely change how you manage trades, and that is the average true range. Okay, so I'm just going to add the average true range to the chart right away. Okay. So this is the average true range indicator, or the ATR for short. Most traders focus only on price action or trend indicators, but they overlook one crucial factor, which is volatility. Now, ATR helps you to measure market volatility, improve trade entries, and stop loss levels like a pro. So in this video, I'm just going to be covering how to use ATR to gauge market volatility, how to set stop loss levels based on ATR instead of random pips. And we're also going to be looking at the best ATR trading strategy for different market conditions. And, of course, I have to show you examples, showing ATR-based trade setup. So stay tuned. And by the end of this video, you'll know exactly how to incorporate ATR into your strategy for more precise trades. Now let's just jump right in. First of all, let us break down what the ATR, or the average true range indicator, actually is and how it works. Now the ATR is a volatility indicator developed by J. Wells Wilder. Unlike other indicators that predict price direction, the ATR measures how much price moves over a given period. It calculates the average range between high and low of each candlestick over a set period, usually 14 candles by default. You can see the default period is 14. All right. So the higher the ATR value, the more volatile the market is. You can see when we had this high ATR reading here, you can see that we had a spike in volatility that even resulted in a gap. Can you see that? So whenever you have, because something similar again happened here and we had a gap again. So whenever you have high ATR values, it means higher volatility, right? And low ATR values means lower volatility. Okay, the higher the ATR value, the more volatile the market is. The lower the ATR value, the more stable the price movement is. So here's why ATR is so powerful. It helps traders identify market conditions, whether the market is trending or ranging. All right, the ATR helps identify whether the market is trending or ranging. And also, the ATR allows for dynamic stop loss placement instead of using a fixed number of pips. Okay, and also, ATR helps traders adjust position sizing based on market volatility. All right, ATR does not tell you which direction to trade. Okay, take note of that. But it helps you understand market conditions and adapt your strategy accordingly. Now, let's just go over how to use ATR step by step in your trading strategy. The first step is to identify market volatility. Basically, it's very easy. If the ATR is rising, it means that volatility is increasing. So whether it's a downtrend or an uptrend, so long as you see that ATR is rising, just know that volatility is increasing. So this one happened in a downtrend, right? Let's go and look for an example in an uptrend. Can you see? The ATR was rising. It shows that volatility was increasing. This was an uptrend. So it doesn't matter the trend. Just know that rising ATR values indicates increasing volatility, and lower ATR values indicates a decrease in volatility, okay? Because if the ATR is falling, it means that volatility is decreasing, okay? So you expect slower movements, all right? But when ATR value is rising, you expect larger price swings. Now, high ATR values suggest strong trending conditions, while low ATR values indicate sideways consolidation. You can see when we had these low values, you can see that the price was moving sideways. All right. The next step is to set your stop loss based on ATR. Now, instead of using a fixed stop loss, you can use the ATR to set dynamic stop losses that adapt to market conditions. Now, here's how. Okay, here's how. Your stop loss it can be equal to your entry price plus or minus. I'm just going to add the formula right here. There's actually a formula for it. Okay, there is a formula for it, right? That is, if you want to use the ATR to calculate dynamic stop losses, right? Stop loss levels. Okay, so you can use the formula stop loss equal to entry price plus or minus ATR value multiplied by the multiplier. Okay, so a common multiplier is 1.5. All right, a common multiplier is 1.5x or 2x depending on the market. Okay, a common multiplier is 1.5x or 2x ATR depending on the market. All right, depending on market conditions, basically, depending on the market conditions. All right, market conditions is what determine market conditions is what determine the multiplier that you are going to make use of. All right. Now, for high volatility, wider stops, which is 2 times ATR, okay, prevent getting stopped out too early. Then for lower volatility, you can use tighter stops, which is the 1.5x ATR, all right, to help manage risk. Okay, so I'm just going to write it down here. To prevent getting stopped out too early. Okay, so that's for higher volatility. So for higher volatility, you can use the 2 times ATR. Okay, then for lower volatility, you can then use tighter stops. All right, you can use the 1.5 ATR to help you manage your risk. Then the next step is to use ATR with moving averages. All right, if ATR is increasing and price is trading above the 50 EMA, okay, if ATR is increasing and price is trading above the 50 EMA, the trend is strong. All right, so you can actually use both the 50 EMA and the 200 EMA. Okay, if the ATR is decreasing and price is near the 200 EMA, it may be a ranging market. Then the final step is to combine ATR with price action. In an uptrend, wait for ATR to spike, then look for a pullback entry. All right, then in a downtrend, you can look for ATR to remain high. In a downtrend, look for ATR to remain high while price forms lower highs. By following these steps, ATR will help you trade with more confidence and precision. Okay, so if you are trading an ATR-based stop loss strategy, if you are using rather an ATR-based stop loss strategy, let's say that you are entering a long trade, for example, maybe on AUD USD, this AUD USD chart, maybe you enter a long trade, say around here. and maybe you are on the 15-minute time frame, maybe the ATR on the 15 minutes time frame is 10 pips. So using a 2x ATR stop loss, your stop would be 1 point. Okay, let's say you entered a long trade around here, right? 0.62552, and then your ATR on the 15 minutes is 10 pips. So using a 2x ATR stop loss, your stop loss will be 20 pips below. 20 pips below, which is going to be around 62552 is our entry. So it's going to be around 62352. Yeah, around 62352. Okay. Then if ATR was 5 pips, your stop loss would be 10 pips below. Remember, because you're using 2x. So if ATR is 10 pips, you multiply 10 by 2, your stop loss will be 20 pips below. If ATR is 5 pips, you're going to multiply 5 by 2, it's going to be 10 pips below, right, for your stop loss. Now, this method ensures that your stop loss adapts to the market's volatility rather than using a random number of pips. All right. Then using ATR for trend confirmation. If ATR is rising while prices move above key resistance, for example, if ATR is rising and perhaps price moves above a key resistance level, right, it confirms strong momentum. But if the ATR is flat or decreasing, it signals a potential consolidation or reversal. By combining ATR with price action and trend indicators, you can filter out weak trades and focus on high probability setups. Now, before you start using ATR, let's go over a few common mistakes traders make. One is using ATR as a signal to buy or sell. Okay, that's bad because ATR only measures volatility. It does not predict direction. Okay, if you see the ATR coming down, it doesn't mean that the price is going to sell. Okay, instead it means that there is decrease in volatility. Then next, setting a stop loss too tight during high ATR periods. Adjust your stop loss based on market conditions, okay? And finally, do not ignore ATR spikes. When ATR suddenly increases, expect big moves ahead. So avoiding these mistakes will help you use ATR more effectively in your trading strategy. And that is it, traders. Now you know exactly how to use the average true range indicator to trade more effectively, set better stop loss levels, and adapt to market volatility. If you found this video helpful, hit the like button, subscribe to the channel also for more expert trading strategies. Turn on notifications so you never miss an update. Also, drop a comment below. Do you use ATR in your trading? What is your favorite ATR setting? Let's get the discussion going. In the meantime, thank you for watching, and I hope to see you in the next video.